Hey everyone, this is Stephen Aguiar, the co-founder of Givepact. You probably heard that there's a lot of drama going on in crypto land. Yesterday, Binance made an offer to buy FTX, which is still up in the air and pending. We think this is one of the most important stories that happened in crypto this year, if not in crypto in general. So we wanted to unpack this a bit and explain what it means for the industry, social impact, and Web3 at large. So the story that came out yesterday is that Binance is put out an offer, a letter of intent to buy FTX. Binance is the first largest exchange in the world. FTX is the second. I want to make a distinction here between Binance, which operates globally, and they also have a subsidiary, Binance US, which is a totally separate entity. And then FTX has the same structure. FTX is a globally operating firm. They also have FTX, which is operating separately, and we'll talk a little bit later about why that matters a lot. But long story short, Binance has issued a letter of intent to buy FTX because there's been a bank run at FTX. Essentially, they don't have enough deposits on file for all the customers to redeem what they bought on the platform. So what happened here? How did we get into this shit show? Number one, it started when Binance was an investor in FTX. When FTX was first launched by Sam Bankman-Fried, their CEO, Binance was one of the first investors. Recently, FTX bought back their stake from Binance, and they paid for some of that stake in cash, but they also paid for some of it, about $2 billion worth of it, with FTT tokens. FTT tokens were a token created by FTX that essentially were useless and didn't do much. They didn't provide governance of the platform. They just basically created these tokens out of thin air, kept most of them, but put out some into the general market so that there was some sort of price discovery. And so with those tokens, they gave them to Alameda Research. So Alameda Research is a trading firm, a prop trading firm, so they trade their own money, not from investors. That was also founded by SBF, Sam Bankman-Fried, who founded FTX. And it's rumored that Alameda basically blew up in June when the whole market crashed, and that FTX basically gave them their FTT tokens to use as collateral on loans. CZ seems to be concerned by this. He saw Alameda on their balance sheet. They had all these FTT tokens that they were using as collateral, and now he was holding all these tokens and was basically at risk that if Alameda defaulted, his bags would basically fall as well. And he was probably also upset that Sam Bankman-Fried was pushing for regulation in Washington that he didn't feel was in the best interest of the industry, and maybe even personally bad for Binance. And so he basically started signaling on Twitter a few days ago that FTX was insolvent, that there were these risks, and triggered a bank run. A bank run is basically when all of the customers go to the exchange and they want to withdraw their funds, and the exchange doesn't actually have them all because they were using them to either speculate on their own or, again, giving it to Alameda as collateral, which also blew up. As far as next steps, we don't know where this is going to go next. Again, there's a letter of intent for Binance to buy FTX. It's not. It's based on due diligence. It's not binding. And I was just checking Twitter a few minutes ago, and there's a report on CoinDesk that first look at the books for FTX. It's not looking good. So this deal may not go through. It could end up in a situation where FTX customers, the FTX has to go under Chapter 11, and FTX customers aren't paid out for years and are maybe just paid cents on the dollar. Huge mess. So how does this fallout affect the world of social impact and the Web3 movement overall? Number one, Sam Bankman-Fried's fall from grace. This was supposed to be the white knight. This was supposed to be the guy that was going to go to Washington and basically push the government to do bipartisan, sensible regulation of the crypto industry. No one trusts him anymore. So this is a huge person that a lot of people perceived as an ally for the crypto industry in Washington, who basically can't be trusted anymore. So it's a huge, huge fall from grace. It's the loss of a huge ally. It's someone that, again, everyone thought was going to sort of get crypto to be respected by the government and politicians, and to push through sensible regulation. This is someone who's an effective altruist that said that he was making money basically to give it back, signed a 99% pledge to donate all his wealth. Number one donor to Joe Biden's campaign for president. Someone who's very engaged in politics. This is, really was supposed to be a lobbyist to push through for sensible regulation. And this fall from grace is definitely going to have repercussions on that side. I also want to say, this is a tweet that I wrote myself. DeFi or decentralized finance will probably end up being a big winner here if there's not any bad regulation that comes through because of it. With decentralized finance apps, we're using exchanges where they don't gamble with user funds. They don't hold them on the balance sheet. These are publicly, these are liquidity pools that are public and transparent. With borrowing on DeFi, all of the loans, the collateral, the liabilities are all transparent. You can look them up. You can see what people borrowed, what they're posting as collateral. With these centralized exchanges like FTX, and we saw with Celsius and Voyager, these are centralized entities where they're taking user funds and using them in systems where you can't track where those funds are going. And so with decentralized finance, you can. And so DeFi can really come out as a winner here because it's a crypto ecosystem that's transparent, where user funds are not being gambled, where loans are over collateralized and can be tracked. It's a huge win for DeFi to come out and say our systems worked, user funds are not at risk. This is code that when someone takes out a loan on DeFi, that loan is paid back first before it's paid back to other lenders because you can't get around the code. You're accountable. So DeFi, transparent, accountability, huge win for them. Number 3, regulation worked in the US. It helped. Again, I wanted to mention that distinction between FTX International and US. People who are internationally using FTX can't withdraw their money right now. But people who use FTX US, a totally separate entity with different regulation, can withdraw their funds. So regulation helped for sure in this instance by protecting user funds in the United States. But again, we should be wary of bad regulation for the more decentralized and transparent entities that were really innocent and worked perfectly fine in this situation, right? Like coming in and imposing regulation on entities that are already transparent and how they work isn't necessarily the solution here. And in a lot of ways, the existing regulation helped a lot, and we should look into what worked in this situation. US consumers, US users of FTX US ended up okay. Lastly, and this is the thing we want to stress the most, the Web3 thesis to cut out the middlemen is as strong as ever. We're still seeing the repercussions of this with Apple. They charge a 30% transaction fee on apps that are published through their platform, and now they want to charge a 30% fee on NFT trades and people that boost ads on Facebook through their platform. Apple has a monopoly on mobile phones, and they're pressing that monopoly at the expense of users. Web3 is all about cutting out the middlemen. It's about creating businesses, actual businesses that generate revenue, not speculating on tokens, and cutting out the middlemen, retaining value amongst users and creators. We're still really optimistic on this thesis. We think it's real. We think we're seeing it play out in real time. When you compare the transaction fees of Apple at 30% and OpenSea at 2.5, we want to see transaction fees come down. We want to see, wealth and value retained amongst users and creators. And this really has nothing to do with FTX. It has nothing to do with token speculation or the price of Ethereum. This is about building better businesses, about building a better digital economy that rewards users and builders. So this is still playing out. Please join us in the Givepact Slack. Just pull up your phone right now, take a picture of this QR code. It will link you right to the Givepact Slack. We're discussing in there. We're sharing articles as it's evolved, and we hope to see you in there. Thanks. Talk later.